Every country you can point to on a map is drowning in numbers it can never touch. The United States carries around $38 trillion in government debt. Japan, roughly $9 trillion. Across the globe, when you add up every government, every corporation, every household, the total passes $315 trillion, over 3 times the size of the entire world economy. But here's the question that doesn't show up in the headlines. The question that should quietly unsettle you. If everyone owes money, who, exactly, is everyone paying? Who stands on the other side of that $315 trillion? We like to imagine a clear villain, a few sinister billionaires, some secret council hidden in a smoke-filled room. The truth is stranger and colder than a conspiracy theory. When you follow the chain of creditors, when you look beyond the headlines and the talking points and actually track who owns the debt, you find something disturbing. The world owes money to itself. Governments owe money to banks. Banks owe money to other banks. Pension funds own government bonds. Insurance companies hold corporate bonds. Central banks hold everyone's IOUs. It's a closed circuit, a financial ecosystem where every liability is someone else's asset. Nothing ever truly leaves the system. Debt is passed, repackaged, refinanced, but almost never eliminated, and that's not an accident. Over 3 centuries, 4 men, 4 bankers in 4 different eras helped design this reality. They didn't sit down together in some secret summit. They never signed a shared blueprint. But each one, facing a specific crisis, made a choice that solved a short-term problem and locked the world into a long-term structure. A structure where governments borrow forever. The principal is never really repaid. Interest flows upward year after year, and the people closest to the tap, banks, asset managers, financial institutions, profit from every payment, every bailout, every so-called rescue. This is not speculative fiction. The meetings happened, the contracts exist, the institutions they created still stand today. Once you understand how they built this architecture, you stop seeing $38 trillion as a crisis to be fixed, and start recognizing it as a feature of the system. So let's go back. Not to the 20th century, not even to the Industrial Revolution, to a world of kings, muskets, and wooden ships, a world where debt still had an ending.
Before the trap, when debt could die before 1694, if a king wanted money, the process was crude but simple. He would approach merchants, rich nobles, or sometimes powerful cities and ask for a loan. In return, he promised to pay it back, principal plus interest often funded from future taxes or plunder from war. If he paid, the debt disappeared. If he didn't, he defaulted. The creditor, some merchant family, a cluster of bankers, perhaps a foreign prince, might be ruined. The king's reputation was damaged. Interest rates spiked next time he tried to borrow. But eventually, after enough time or enough force, the slate was wiped clean. The debt cycle had an off switch. It was risky, chaotic, and often brutal. Spain, for example, defaulted multiple times in the 16th and 17th centuries. Despite hauling in silver from the Americas, lenders learned that lending to monarchs was profitable until suddenly it wasn't. But there was one saving grace in this primitive system: debt remained temporary. It could be repaid, it could be defaulted on. Either way it ended. That would soon change. William Paterson and the idea that never expires. Enter William Paterson, a Scottish merchant, a dreamer with more schemes than successes. Before his big idea, he'd tried and failed at speculative ventures, including a disastrous colonization effort in Panama. He was not a moral hero, not a philosopher. He was a problem solver in search of a jackpot. And in 1691, as Europe bled money in endless wars, he found his opportunity. England was locked in conflict with France. King William III needed cash urgently. The treasury was empty. Tax revenues lagged behind the cost of war. And traditional lenders, burned by England's earlier defaults, weren't eager to extend credit again. Paterson walked into this crisis with a proposal so radical that it would quietly reshape the modern world. He offered to organize a group of wealthy merchants and financiers to lend the government £1.2 million, roughly equivalent to hundreds of millions of dollars today. A massive sum. But the real innovation wasn't the amount, it was the terms. The loan would never be repaid. Instead, the government would pay 8% interest every year, indefinitely. In return, Paterson proposed creating a new institution to manage this arrangement, the Bank of England, the birth of permanent national debt. Here's how the mechanics worked. A group of merchants and wealthy investors pooled their gold. That gold was deposited into the newly formed Bank of England. The bank then lent this money to the government. The government promised to pay annual interest, funded by taxes. The principal, the original £1.2 million, would never be repaid. From the government's perspective, it was like buying time with no expiration date. From the banker's perspective, it was purchasing a permanent income stream. Why would the merchants agree? Because for the first time in English history, these payments weren't backed by personal promises or royal honor. They were backed by something more powerful: Parliament's legal right to tax the entire population of England, as long as England existed. As long as it could levy and collect taxes, the interest would flow, and the paper they received from the bank, banknotes and government bonds, could be traded and sold. They weren't just claims on future taxes, they became money, better than money. In fact, because unlike gold coins sitting in a chest, these pieces of paper paid interest. In 1694, Parliament approved Paterson's proposal. The Bank of England was chartered. The merchants delivered their gold, the government got its war chest, and for the first time in world history, national debt became permanent. Not a temporary burden to be lifted, not a crisis to be resolved, but a structural feature of the state. Why it was brilliant for bankers and disastrous for taxpayers. Let's translate the numbers. An 8% annual interest rate on £1.2 million meant the English government owed £96,000 every year, essentially forever. The merchants and financiers had bought what we'd now call an annuity from the government, a slice of tax revenue built into the system like a line of code. If any individual investor wanted their gold back, they didn't go to the king. They simply sold their claim, the bond or the banknote, to someone else. The debt remained, but its ownership shifted silently in the background. The obligation never died. Only the names and the certificates changed. The real genius and danger came with the next step. The Bank of England wasn't just a vault. It was given the right to issue banknotes backed by government debt. That meant the bank could create paper money up to the value of the loan it had granted the state. The government SIOU, its promise to pay interest forever, became the foundation for new money. This is the template that still runs in the background of modern economies. Government borrows. It never truly repays the principal. It services the interest forever, using taxes. The debt itself becomes part of the money supplied. It is elegant if you're sitting on the creditor side. It is suffocating if you re the one paying taxes your entire life into a system where the principal never shrinks. Within 50 years, other European powers copied the blueprint. France, the Netherlands, later the newborn United States, under Alexander Hamilton, would adopt a version of the same model: permanent national debt, interest funded by taxes, government bonds circulating as near money. Paterson died in 1719, not particularly rich. His name hardly known outside economic history, but the system he helped design is still alive. The Bank of England still stands. British government debt has been rolled over, refinanced, expanded, but never fully erased. The first layer of the trap was in place. Debt no longer had to end. What began as a desperate wartime workaround had quietly become the backbone of modern finance. But turning national debt into a permanent feature was only the beginning. To make the trap inescapable, that debt had to be scaled, industrialized, and woven into a network so complex that failure became unthinkable. That task would fall to the second architect, a banker who understood not just money, but information, fear, and timing. And he would use a battlefield named Waterloo to show the world how powerfully debt could rule nations. Before the 19th century, national debts existed, but they were still local. A country borrowed from its own merchants, or perhaps from a neighboring kingdom. The debts were large, but the network was small. A default might cause regional panic, but it would not topple the entire financial structure of Europe. One family would change that, a family whose name became synonymous with wealth, intrigue, and the quiet machinery of geopolitical power. The Rothschilds, the rise of the most connected bankers in Europe. The Rothschild story began modestly enough in Frankfurt. Meyer Amschel Rothschild, the patriarch, was a coin dealer and money changer, one of thousands scattered across Europe. But his true insight was not in metals, it was in networks. He trained his 5 sons and sent each to a different financial capital. London, Paris, Frankfurt, Vienna, Naples, at a time when information traveled by horseback and courier ships. This was revolutionary. The brothers created a communications web faster and more reliable than any government channel. Their coded letters moved through private couriers, bypassing military checkpoints and official censorship. They weren't just bankers, they were an information superhighway in a world still stuck in dirt roads. By the early 1800s, as the Napoleonic Wars ravaged Europe, governments were desperate for financing, not just to win battles, but to survive the next month's payroll. And this is where Nathan Rothschild, the most brilliant of the brothers, stepped onto the stage. Nathan Rothschild and the invention of modern bond markets. Nathan, based in London, understood something that European rulers and generals were only beginning to grasp. War wasn't won by swords or cannons. War was won by funding. Britain needed money rapidly and in unpredictable amounts. Traditional lenders couldn't react to the speed of war. Nathan could. He introduced a radical innovation in sovereign finance. Instead of lending money directly to governments, he would buy government bonds at a discount, then resell them to investors across Europe. This created the first true secondary market for sovereign debt. Governments got immediate cash. Investors got tradable, interest-bearing assets. Rothschild pocketed the difference, the spread, and because he controlled the distribution network, governments had no choice but to go through him. What William Paterson did for permanent debt, Nathan Rothschild did for scalable debt. Debt was no longer a static agreement. It became a product, something that could be bought, sold, leveraged, and used as collateral. And then came Waterloo. The Waterloo play information as a weapon in 1815. The fate of Europe rested on a single field in modern-day Belgium. Napoleon versus the British-led coalition. Whoever won would reshape the continent. London waited desperately for news. Communications were slow. Rumors could swing markets violently. But thanks to his courier network, Nathan Rothschild learned of Napoleon's defeat before anyone else in London, nearly a full day earlier. What he did next became legend. Nathan walked into the London Stock Exchange and began selling British bonds, the very bonds he was famous for championing. Investors panicked. If Rothschild was selling, it must mean Britain had lost. Prices collapsed. And then, at the exact moment of maximum fear, Nathan quietly bought enormous quantities of those same bonds at fire sale prices. When official news of victory arrived the next day, the market surged. Nathan's position exploded in value. Modern finance would call this information arbitrage. At the time, it was considered shrewd, almost magical. But more importantly, it cemented the Rothschilds as the dominant financial force in Europe. Governments realized they needed funding, they needed distribution, they needed access to investors across borders. And only Rothschild had the infrastructure to provide it. By the 1820s, three things were true. No major European government could raise money without Rothschild involvement. Rothschild's bonds circulated internationally, tying economies together. A default was no longer a local issue, it became a continental threat. The birth of the inescapable debt network. Before the Rothschild era, a king could default, suffer the consequences, and move on. It was messy, yes, but contained. After the Rothschild innovations, sovereign debt was owned by French investors, German banks, Dutch insurers, Italian aristocrats, British pension funds. If one government defaulted, the damage rippled outward like cracks in glass. A single missed payment could sink banks, freeze credit, collapse currencies, destabilize neighboring governments. Default was no longer a financial choice. It became a geopolitical bomb, and this was the true Rothschild innovation. Make sovereign debt so interconnected that no government can default without threatening the entire system. Governments became trapped. To pay old debt, they borrowed more. To avoid crisis, they issued new bonds. Debt snowballed not because kings were reckless, but because the structure gave them no exits. The Rothschild wealth soared with each cycle. They became richer than most royal families, not by producing steel, or cotton, or ships, but by selling the world's most powerful product, government promises. Promises backed not by gold, not by kings, but by the tax revenues of entire nations. Paterson had created permanent debt. Rothschild turned it into a global web, a system where every government owed someone abroad, and where default became almost impossible. But there was still one limit. Governments could only borrow as much as the market could absorb. No matter how wealthy the Rothschild network became, there was still a ceiling. That limit would vanish in the early 20th century. Thanks to the third architect, a banker who understood that to remove all constraints, you needed something more powerful than markets. You needed a central bank with the authority to create money from nothing, and one man would orchestrate it from inside a private library on Jekyll Island. By the dawn of the 20th century, the first two layers of the debt trap were firmly in place. William Paterson had made national debt permanent. Nathan Rothschild had made sovereign debt global and interconnected. But even with these innovations, debt still had one remaining limit. Governments could only borrow as much money as markets physically had to lend. If banks ran out of gold or if investors panicked, the system could still freeze. The world needed a mechanism that could create buyers out of thin air, a force capable of absorbing infinite government IOUs. And in the United States, that constraint would be shattered by a man whose name became synonymous with American finance, J.P. Morgan. America before Morgan's revolution. At the turn of the 1900s, the United States was rising fast, industrializing, urbanizing, and attracting waves of immigrants. But behind the growth was a fragile financial system. Thousands of small, fragmented banks. No central authority to stabilize panics. Money tied to gold, which limited supply. Markets capable of seizing up with little warning. European investors viewed the US as volatile and immature. Americans themselves had a deep distrust of centralized financial power. They had already destroyed two central banks in the 1800s, seen as tools of elite control. Yet as the economy grew, cracks widened, and in 1907 those cracks became a chasm. The panic of 1907 when Morgan became America's central bank. The trigger was small, a failed speculation in copper. But in the brittle financial system of the time, that spark spread like wildfire. Bank runs erupted, stock prices collapsed, major trust companies teetered, credit froze across the country. There was no Federal Reserve, no stabilizing mechanism. The government was powerless, lacking both funds and a unified banking structure. One man stepped in. J.P. Morgan locked the nation's top bankers inside his library and refused to let them leave until they agreed to rescue the financial system. It was a moment straight out of a cinematic thriller. Morgan, a titan of Wall Street with a piercing stare and an iron will, forced rival bankers to inject millions into collapsing institutions. It worked. The panic ended. Markets stabilized. The economy survived. But the event terrified lawmakers. They had just witnessed a private citizen, unelected, unaccountable, save the U.S. economy through sheer personal authority. America had a choice. Either rely on Morgan forever, or build a system that would replace him. Morgan already knew which direction things would go, and he intended to shape that system to his advantage.
The secret meeting that created a new world in November 1910. 7 of the most powerful men in American finance boarded a private train in secrecy. They told reporters they were going on a hunting trip. The conductors were instructed not to use their names. Even the servants were sworn to silence. They traveled to a secluded location in Georgia, Jekyll Island. For 9 days, behind closed doors, they drafted the blueprint for what would become the Federal Reserve System. Those present included Senator Nelson Aldrich, tied by marriage to the Rockefeller family, executives from J.P. Morgan's banks, representatives from Kuhn, Loeb & Co., leading figures from the national city bank, today's Citibank. The reason for secrecy was simple. Americans hated the idea of a central bank, so the bankers designed one that looked decentralized and democratic while still ensuring their control. How the Fed was engineered to serve the banking class. The Federal Reserve Act of 1913 created 12 regional Federal Reserve banks, a board of governors in Washington, a system of private member banks, a central authority with the power to buy government bonds, issue currency, and set monetary policy on paper. It looked balanced. In practice, the structure gave Wall Street extraordinary power. The regional Federal Reserve banks were privately owned by member banks. Those banks elected directors who influenced policy. The most powerful institution, the New York Federal Reserve Bank, was effectively controlled by the biggest Wall Street banks, chief among them, Morgan's. Critically, the Fed was given the ability to create money to buy government bonds. This single feature, invisible to the public at the time, changed everything. Before the Fed, government debt was limited by the money available to lend. After the Fed, the Federal Reserve could conjure new money to buy unlimited government debt. Demand for government bonds became effectively infinite. Why this mattered? The era of limitless debt began. Let's break down the new mechanism. The US government issues a bond, an IOU. The Federal Reserve buys that bond with money it creates out of nothing. The government receives spending power, funds to wage war, build railroads, expand programs. The bond sits on the Fed's balance sheet. Taxpayers pay interest on that bond forever. This was the missing piece that Patterson and Rothschild never had, a central bank that could buy debt without limit. From this moment forward, government borrowing could expand indefinitely. The supply of money itself became tied to the supply of debt. Economic cycles became dependent on perpetual borrowing, and the financial class, which owned the banks that owned the Fed, collected a steady, permanent stream of interest from taxpayers. Morgan died in 1913, the same year the Federal Reserve was created. It was poetic, almost symbolic. His personal power faded. His institutional power became eternal. The third layer of the trap. Patterson made debt permanent. Rothschild made it global. Morgan made it infinite. But there was still a problem. What happens when nations, especially poorer ones, cannot pay the interest on their debt? Before the 1970s, default still happened. Nations could still walk away. Banks could still suffer losses. The system needed a way to prevent default, even when repayment was impossible. It needed a mechanism to keep borrowers locked in the system, even after they were underwater. And that solution would come from a man who believed inflation threatened the world. A man whose policies would reshape global economics and turn developing nations into permanent debtors. By the 1970s, the first three pillars of the modern debt machine were already in place. Patterson made national debt permanent. Rothschild made sovereign debt global and systemically interconnected. Morgan built the Federal Reserve, making debt limitless by allowing money creation through bond purchases. But there was one weakness left in the system. What happens when a country simply cannot pay? Historically, nations that couldn't meet their obligations defaulted. It was messy, yes, but it reset the system. Debt vanished, losses were absorbed, economies rebuilt. But the architects of the global financial system couldn't allow that anymore. By the late 20th century, global banks, pension funds, and governments were holding each other's debt like a web of glass threads. A single sovereign default could trigger chain reactions capable of collapsing entire economies. If the first three architects built the debt machine, the fourth would weld the doors shut. His name was Paul Volcker, a man whose decisions would turn temporary debt problems into permanent servitude. The Volcker era, a world drowning in inflation. When Paul Volcker became chairman of the US Federal Reserve in 1979, the American economy was on the brink of catastrophe. Inflation wasn't just high, it was explosive. The 1970s oil crises had doubled and tripled energy prices. The dollar was collapsing in credibility after the US abandoned the gold standard in 1971. Global investors were losing faith in American financial stability. Volcker believed the inflation spiral threatened the world's trust in the dollar, and with it, global finance itself. So he did something both brutal and unprecedented. He pushed interest rates to 20%, the highest in American history. This move crushed inflation, but it had a side effect so powerful that it reshaped the global system. Because throughout the 1970s, developing nations had borrowed billions in dollar-denominated loans at low interest rates. These loans had funded highways, dams, power plants, and modernization efforts. When the US interest rate shot up, so did the rates on those loans. Suddenly, Mexico, Brazil, Argentina, the Philippines, Turkey, many African nations, found themselves unable to service their debt. The math simply didn't work anymore. Their interest payments ballooned to levels exceeding their export earnings. Bankruptcy was inevitable. And then in 1982, the dam finally broke. The day default should have happened in August 1982. The Mexican finance minister informed the US Treasury, Mexico can no longer meet its debt obligations. This was not a minor tremor, this was an earthquake. Why? Because American banks, especially Citibank, Chase Manhattan, and Bank of America had lent heavily to Mexico, Brazil, and Argentina. If these countries defaulted, the losses would wipe out the capital of major US banks. The entire American financial system was at risk. Volcker faced a fateful choice. let the banks take their losses as capitalism supposedly demands, or create a mechanism to keep debtor nations paying interest indefinitely, even if they could never repay the principal. Volcker chose option 2, and that decision created the era of structural adjustment, a polite phrase that masks a brutal reality. The IMF steps in and the debt trap becomes global instead of allowing default. Volcker orchestrated a rescue through the International Monetary Fund (IMF), but this wasn't a humanitarian bailout. It was a bailout of the banks. The IMF would lend Mexico enough money to cover interest payments to American banks, require Mexico to impose strict austerity measures, force privatization of state industries, require currency devaluation, open its markets to foreign investors, cut public spending, healthcare, education, and social programs. In effect, the IMF loans kept the interest flowing to US and European banks, while ordinary people in debtor nations absorbed the pain. The debt itself never reduced, never forgiven, just rolled over. Volcker's innovation wasn't stabilizing the system. It was preserving the system at any human cost. The birth of the modern debt prison model from 1982 onward, the pattern repeated. A developing country borrowed heavily in good times. Global interest rates rose, or commodity prices fell. The country couldn't pay. Default became imminent. The IMF stepped in not to erase the debt, but to keep payments flowing. The nation surrendered economic sovereignty. The debt grew larger, not smaller. Some victims of this cycle: Brazil, multiple IMF packages; Argentina, over 20 IMF programs; Indonesia, 1997 Asian crisis; Thailand, South Korea, Greece, 2010 austerity disaster; Sri Lanka, 2022 collapse. Every time, bankers were saved. Every time, taxpayers either in the debtor nation or abroad footed the bill. Every time, the debt persisted. Volcker didn't create international debt, but he created the doctrine that debt must never die, that default, the ancient reset button of civilization, must never again be allowed. If Patterson laid the first brick, if Rothschild wove the web, if Morgan built the engine, Volcker welded the system shut, sealing nations inside a structure from which they could no longer escape. The four pillars stand complete. When you combine the contributions of the four architects, you get the modern world. Permanent debt, Patterson; globalized, interconnected debt, Rothschild; unlimited money creation to support debt, Morgan; no default allowed, only restructuring, Volcker. That is the architecture holding up the $315 trillion of global debt today. But the system has grown far beyond these four pillars. It now operates on a global scale with a mechanism so large, so intertwined, and so dependent on perpetual borrowing that even understanding it requires pulling back the curtain. Because the final step in this story is the most unsettling one. The world cannot repay its debt, not because it is irresponsible, but because repayment would collapse the system itself. And that is where we go next. By the time the 21st century arrived, the four architects had already constructed a machine so vast, so deeply embedded in global society, that almost no one alive today has ever seen the world without it. A world without national debt. A world without central banks creating money from government IOUs. A world where default resets the system instead of detonating it. Instead, we live inside something else entirely. A system where governments, corporations, and households borrow endlessly, not out of greed or incompetence, but because the system requires perpetual debt to function. To understand why repayment is impossible, we must examine the machine from above, as a whole. The debt pyramid. Who owes $38 trillion? Let's start with the United States. The US government owes $38 trillion in official national debt. Here's the breakdown. $20 trillion is owned by the American public: pension funds, mutual funds, insurance companies, banks. The Federal Reserve itself, $18 trillion is owed internally. The Social Security Trust Fund, the Medicare Trust Fund, other government accounts. This is where the illusion becomes obvious. The government owes money to itself. Programs that citizens pay into Social Security, Medicare, have had their funds lent to the federal government, which spent them long ago. So how does the government repay these trust funds? It doesn't. Not in any real sense. When Social Security needs cash, the government must raise taxes, cut spending, or borrow even more from the public or the Fed. It says a circular flow, a shell game where the IOUs simply move from one pocket to another, while taxpayers fund the interest indefinitely. This is the model that now defines almost every advanced economy. Japan's debt, mostly owed to itself; Europe's debt, mostly owed within the EU; China's debt, mostly held by state banks. Every country is running the same pattern. Every country fears the same collapse. Every country relies on the same financial structure. And globally, the numbers are staggering. World debt, $315 trillion. World GDP, $105 trillion. Debt is now 3 times the size of the entire global economy. But here's the crucial point. This debt cannot be paid off, not because governments won't, but because repayment would destroy the money supply itself. The impossibility of repayment, why the machine breaks if debt shrinks in the modern system. Money is created when governments borrow. When the US issues a treasury bond, the Federal Reserve can create dollars to buy it. Those dollars enter circulation through government spending, commercial lending, financial markets. This means the money supply is tied to the debt supply. If the US government somehow repaid its $38 trillion, the corresponding dollars would vanish from the financial system. The result: Massive deflation, banking collapse, asset prices imploding, unemployment skyrocketing, and depression deeper than 1929. The same applies worldwide. If global governments repaid the $315 trillion they owe, the world's effective money supply would shrink by roughly 2. International trade would freeze, banks would collapse, currencies would panic, markets would crater. In other words, debt is not just part of the system, debt is the system, where the interest flows, the hidden wealth transfer. If the principal can never be repaid, then what about the interest? This is the heart of the modern wealth machine. In the US alone, interest payments now exceed $1 trillion per year. Where does it go? Asset managers like BlackRock, Vanguard, and State Street, insurance giants, hedge funds, banks, pension funds, wealthy bondholders. In short, interest is a silent tax that transfers wealth from workers to capital owners. Unlike income tax, you never vote on it. Unlike sales tax, it isn't printed on your receipt. It's embedded in the structure, invisible, automatic, constant. And because the debt is never repaid, this wealth transfer continues forever. The global web, everyone owes everyone. This is where the system becomes truly inescapable. Japan holds US treasuries. The US funds the IMF. The IMF lends to Europe. Europe invests in Asian bonds. China holds US debt. US funds by Chinese corporate debt. Middle Eastern sovereign funds by European bonds. Developing countries owe the World Bank. The World Bank borrows from global markets. It's a closed, circular network of financial Ouroboros. When one country fails to pay, the losses transmit through banks, pension funds, central banks, currency markets, trade flows. This is why Volcker's doctrine, no more defaults, became the global rule. Default anywhere is a crisis everywhere. Debt restructuring becomes the only politically acceptable option. And restructuring doesn't reduce debt, it extends it. Every bailout is simply a new loan to keep paying the old loan. The system keeps running, and the interest keeps flowing. The four architects, their system is now complete. They lived in different centuries. They never met, but their solutions stacked perfectly. Patterson, 1694, make national debt permanent. Rothschild, 1815, make sovereign debt global and interconnected. Morgan, 1913, enable unlimited central bank absorption of government debt. Volcker, 1982, prevent defaults, make debt inescapable. Together, they created a world where governments can never stop borrowing, debt never shrinks, interest never stops flowing. The financial elite collect rent on civilization itself. Debt isn't a flaw, it's not a mistake, it's not mismanagement. Debt is the operating system of the modern world. The final reveal, what it means for us. If you follow the story to this point, you now understand something most people never realize. The global financial system is not designed to be repaired. It is designed to be perpetual. Debt will grow, interest will compound, governments will roll over obligations, crises will be solved by creating more debt, and the beneficiaries, financial institutions, asset managers, bondholders, will continue collecting the rent. Because in this system, debt is the product, interest is the profit, and taxpayers are the revenue stream. This is why $38 trillion isn't a crisis, it's a business model. This is why $315 trillion globally isn't an emergency, it's the architecture. And this is why no politician left, right, or center can fix it. To fix it would mean tearing down the structure of modern money itself, a structure built over 331 years, by four architects, across 3 centuries, to ensure one outcome, a world that can borrow endlessly, but can never escape.